$2.4 billion. I mean, that's not the GDP of a small island nation, right?
No, definitely not.
And it's not the budget for some summer blockbuster. $2.4 billion is the transaction volume that Polymarket, a decentralized prediction market, processed during the 2024 U.S. presidential election alone.
Just a staggering amount of money.
Right. An absolute mountain of money. And it's flowing not into stocks, not into bonds, but into, well, bets on human events.
Yeah, and wherever there is a mountain of money, in human emotion, you can bet there are quantitative analysts trying to build systems to siphon it away.
Exactly.
It completely reframes how we have to think about prediction markets today. I mean, we aren't talking about niche academic novelties or, small-scale gambling sites anymore.
Not at all.
These platforms have evolved into massive, highly sophisticated financial engines. They basically act as clearinghouses for global anxiety.
Wow, clearinghouses for anxiety. I like that.
Yeah, they aggregate the beliefs, the fears, and the alleged insider knowledge of a massive pool of participants.
Which means they are totally ripe for exploitation if you know what you're doing. So today, we are tearing apart a new algorithmic strategy that, frankly, it doesn't care about politics.
Yep.
It doesn't even care if an event is actually going to happen. It only cares if the crowd panics.
That's the key.
Right. We are jumping into a really fascinating research paper. This was published in April 2026 by Quantpedia, and it's titled Exploiting Mean Reversion in Decentralized Prediction Markets.
It's a great paper.
It really is. And just to be crystal clear with you listening, we are not here to debate the actual likelihood of these events happening.
Right. No politics today.
Exactly.
Yeah.
The quants who wrote this paper aren't theologians. They're not geopolitical analysts. They are purely looking at the math of human overreaction.
Yeah, the central question of the research is entirely quantitative. It's basically, can you systematically make money off transient, sentiment-driven price deviations?
And the pre-freakouts, basically.
Right. But before we get into the algorithm itself, we have to understand the specific instrument being traded. Because, it's fundamentally different from buying a share of Apple or Microsoft.
Oh, for sure.
On Polymarket, you are dealing with binary contracts.
Okay, let's unpack this, because I always find binary contracts fascinating. They're so stark, right?
Very stark.
A contract settles at exactly one of two values. It's either $0 if the event doesn't happen, or $1 if the event does happen. Or, if you want to think in pennies, 0 cents or 100 cents.
Right.
So how does a fluctuating price even work if the final payout is fixed?
Well, the price of the contract at any given moment before that final settlement represents the crowd's implied probability of the event occurring.
Okay.
So if a contract is trading at 30 cents, the market is essentially saying there's a 30% chance the event happens.
Makes sense.
And because the terminal value is definitively 0 or 1, that price discovery phase, the months or years leading up to the event, it's incredibly sensitive to new information.
Right, so the researchers aren't trying to figure out if that 30-cent contract should theoretically be priced at 40 cents based on, complex, real-world fundamentals.
Not at all.
They're just looking for the momentary freakouts. A news alert flashes across social media, the crowd panics, they oversell the contract.
Yeah, exactly.
And the price drops artificially low for just a few hours or a couple of days before creeping back to its baseline?
Yeah, it's an averaging down or reversal approach. The hypothesis is that these extreme price movements are often overextensions.
They stretch too far.
Right. The market reacts emotionally rather than rationally. And if you can identify when a contract is oversold relative to its recent history, you can step in, buy it at a discount, and ride the wave back up as cooler heads prevail.
So to test if this emotional panic is actually exploitable, we can't just look at a generic contract. We need to stress test the algorithm against, completely different extremes of human anxiety.
Yeah, you need a diverse data set.
Right. And the researchers picked 3 specific events resolving in 2025 that are basically on entirely different planets.
What's fascinating here is they needed to control for different levels of inherent baseline risk.
Okay.
The goal was to capture high-frequency data. We're talking roughly 1 full year of pricing, sampled at precise 10-minute intervals across a whole spectrum of volatility.
10-minute intervals for a year.
Yeah. That is over 40,000 distinct data points per contract. It provides a massive data set to really test how crowd psychology behaves under totally different conditions.
Wow. Okay, so let's start with the absolute baseline. Contract number 1 is the no side of the question. Will Jesus Christ return in 2025?
Right. And from a quantitative perspective, this contract functions effectively as a quasi-risk-free asset.
Risk-free?
Well, practically. The probability of it settling at par, meaning the no side wins and pays out a full dollar, is treated by the market as overwhelmingly high. Because there is virtually no day-to-day news flow that dramatically shifts the probability of this event, it displays minimal volatility.
Not a lot of breaking news on that front.
Exactly. If you simply bought this contract and held it to maturity as a passive buy-and-hold strategy, the data shows it yielded a steady compound annual return, or QRR, of positive 5.98%.
I love that. I mean, in the Wild West of decentralized prediction markets, the second coming of Christ basically operates as your U.S. Treasury bond.
Pretty much.
It's the safe, low-yield bedrock of a portfolio. It's just the time value of money. But then we swing to the exact opposite end of the spectrum. Contract number 2 is the no side of, will China invade Taiwan in 2025?
Right. Now, this represents an immense shift in uncertainty. Geopolitical events are driven by continuous, unpredictable real-world developments.
Very volatile.
Highly volatile. This contract operates much more like a high-yield corporate bond, or what traditional fixed-income markets would call junk bond. It has substantially elevated volatility. The passive buy-and-hold strategy looks fantastic on the surface, a positive 12.69% CAR, but it comes with massive drawdowns.
Oh, massive.
Well, at one point, the passive position experienced a peak-to-trough decline of over 24%.
Oh, wow. That is a stomach-churning drop for a trader. You can easily imagine why, too. I mean, a rumor circulates about military exercises in the Strait, the yes side spikes, the no side plummets, and anyone holding that contract watches a quarter of their portfolio value just evaporate in an afternoon.
Yeah, exactly. It's brutal.
And finally, we have contract number 3, which is just the ultimate wild card. Will the U.S. confirm that aliens exist in 2025?
Right. Another highly speculative, high-yield instrument, but driven by a completely different type of sentiment.
Alien sentiment.
Yeah. The buy and hold on the alien contract yielded a positive 8.63% CAR, but again, with huge volatility. We're talking over 44% annualized volatility and a maximum drawdown of nearly 22%. But by analyzing these 3 incredibly distinct markets, the stable treasury, the volatile geopolitical crisis, and the deeply weird sci-fi speculation, the researchers isolated how mean reversion performs across the entire risk spectrum.
Okay, so we have our 3 assets, and we have mountains of high-frequency data. How exactly did the algorithm attempt to trade this? Because, algorithmic trading often sounds super intimidating.
It's full of machine learning black boxes.
Right. But the framework here is actually refreshingly simple. It revolves around 2 variables, which the paper calls hyperparameters, X and Y. Let me float an analogy here for you listening to see if we can visualize this.
Go for it.
Think of the contract price as a rubber band. The X variable is the algorithm trying to figure out how far that rubber band has been stretched compared to its recent history. Are we looking back 5 days to see if it's stretched to a new low? 10 days? 20 days?
Yeah.
If the current price drops down to hit that historic low, you buy. You grab the rubber band. And then the Y variable is how long you hold on to it, waiting for it to snap back to equilibrium before you let go and take your profit. Do you hold it for 1 day, 2 days, or 5 days?
The rubber band is a really good start for the X variable because it captures that concept of tension and overextension. But for the Y variable, think of it more like a pendulum.
Oh, a pendulum. Okay.
The X is figuring out how far the pendulum has swung into panic territory. But when it starts swinging back toward rationality, it doesn't just freeze perfectly in the middle instantly.
Right, swings past it.
Exactly. The Y holding period is giving it enough time, say 3 or 5 days, to finish swinging and actually settle back into its rational center before you take your money off the table.
Okay, that makes a lot more sense mechanically. You can't just hold a snapped rubber band.
Yeah.
So to find the absolute optimal strategy, the researchers basically just threw the kitchen sink at the problem.
He did.
They used a grid search approach. For the look-back window, X finding that historical minimum price, they tested 5, 10, and 20 days. And for the holding period, while waiting for the pendulum to settle, they tested 1, 2, 3, and 5 days. That gives us 12 total strategy variants. And every time a signal fired, they reinvested the full capital to keep the compounding clean.
Yeah, and the critical step in this methodology is the separation of theoretical performance from practical reality.
This is huge.
Right. The researchers first ran all 12 strategies through a simulation using what they call a zero-spread model. This assumes a frictionless universe.
The dream.
The dream, yeah. It assumes you are using passive limit orders with absolutely zero transaction costs, no exchange fees, no slippage, no bid-ask spread to overcome. It represents the theoretical maximum edge available purely from the mathematical trading signal itself.
Here's where it gets really interesting, because in this zero-cost fantasy land, the algorithms absolutely print money.
Oh, they do?
Let's look at the Jesus contract, our low-risk treasury bond. Remember, buy and hold gave us a 5.98% return. Under the zero-spread model, a fast-paced strategy, specifically X equals 5, Y equals 1, yields a 7.95% return.
Which is a nice bump.
Yeah. It means you look back just 5 days for a price drop, buy it, and hold it for just 1 day before selling. It boosted the return, but more impressively, it achieved a massive Sharpe ratio of positive 2.97.
And that's incredible. The Sharpe ratio is essentially a measurement of risk-adjusted return. It tells you how much excess return you are receiving for the extra volatility you endure.
Okay.
A Sharpe ratio over 1 is generally considered good, over 2 is excellent, nearing 3 is almost unheard of in traditional equities.
Oh.
It means the algorithm was generating exceptional returns with an incredibly smooth upward equity curve.
And if you think that is wild, look at the high-yield China contract in the zero-spread fantasy. Buy and hold was roughly 12.7%. That same fast-paced X5Y1 strategy, it generated a staggering 30.98% compound annual return.
Right, the data strongly suggested that short look-backs and quick exits trading almost hyperactively was the holy grail of prediction markets.
But wait, we all know trading isn't free? What happens when the researchers add a tiny, seemingly insignificant 10 basis point, that's 0.1% fee per trade, to simulate real-world market orders and slippage?
Well, because trading is never free, right? Even on decentralized platforms, there is the reality of market friction. There is the exchange fee. And more importantly, there is the bid-ask spread.
The gap.
Right, the inherent gap between what a buyer is willing to pay and a seller is willing to accept at any given second. The researchers took those massive theoretical profits and ran the exact same simulation, but this time, like you said, they added a 10 basis point fee per trade to simulate real-world conditions.
For context, 10 basis points is just 1/10 of 1%. 0.1%. If you are not a professional trader, that sounds like a rounding error. It sounds entirely negligible.
It's the difference between a money printer and a money incinerator.
Wow.
When they introduced that 0.1% per trade friction, the performance degradation was absolute. Let's revisit that optimal X5Y1 strategy for the Jesus contract, the one with the unheard of 2.97 Sharpe ratio.
Right, the golden goose.
Under the realistic friction model, it completely collapses. It falls from being the best performer to the absolute worst out of all 12 variants, dropping to a negative 7.83% annual return.
I want to break down exactly why that happens, because this is really the core lesson of the paper. If the contract price drops by 1 cent and you buy it hoping it bounces back up that single cent, a 0.1% fee on the buy and another 0.1% fee on the sell literally eats up your entire 1 cent profit margin.
Precisely.
You are taking on all the market risk, doing all the work of executing the trade, and you are just handing your theoretical profits straight to the exchange.
Yeah. Strategies with high turnover, meaning the algorithm is trading constantly, reacting to every 5-day dip and selling 24 hours later, are mathematically beautiful in a vacuum, but they are economically unviable in practice.
Because of the fees.
Every single time the algorithm fires, that tiny friction cost takes a bite. When you day trade a low volatility asset like the Jesus contract, the actual price movement is so small that the profit margin on the mean reversion cannot absorb the cost of the trade. The friction just eats the alpha alive.
Right. So if you're listening and sitting there thinking, great, I'll just write a Python script to buy every 5-day dip and become a millionaire, you are going to get wiped out by the math.
Completely wiped out.
So what does this all mean? Does that mean mean reversion is totally useless for the average person trading in the real world?
Not useless, but it requires a fundamental shift in strategy. You have to abandon the hyperactive day trader mindset and adopt what we might call patient capital.
Patient capital.
Yeah, when the researchers looked at the strategies that actually survived and thrived under the 10 basis point friction reality, a very clear pattern emerged.
What was it?
Across the board, the longer horizon strategies, specifically where the look-back window was 20 days and the holding period was 5 days, consistently ranked among the top performers for risk-adjusted returns.
The alien contract under real-world conditions proves this perfectly, actually. The fast one-day holding strategies got crushed by fees. But the X10 Y5 strategy, where the algorithm waits for a 10-day historical low, buys the panic, and holds for 5 full days, achieved a massive positive 22.09% annual return.
Amazing.
Right. That completely outperformed the passive buy and hold strategy by 2.6 times on a risk-adjusted basis.
If we connect this to the bigger picture, the underlying dynamic here fundamentally comes down to the concept of signal-to-noise ratio.
Okay, break that down for us.
Well, think about the risk-free Jesus contract again. It barely moves. Any small 5-day price dip is likely just market noise, a random, meaningless microfluctuation.
The blip.
Right. If your algorithm trades that noise, you bleed out from fees. But the alien and China contracts possess much higher intrinsic volatility. When one of those contracts hits a 20-day historical low, it is rarely a random fluctuation. It is a genuine, significant mispricing driven by an intense emotional overreaction from the crowd.
Right. The panic over a geopolitical headline or, a weird congressional hearing about UFOs creates a massive crater in the price. That is a strong signal.
A very strong signal. The mispricing is large enough that when the pendulum finally swings back to a rational equilibrium, the profit margin is substantial.
It covers the fees.
Yes. It is wide enough to comfortably absorb the friction costs of entering and exiting the trade, leaving actual real-world profit for the trader.
I love how the quantitative data perfectly validates the human psychology there. The crowd panics, they aggressively dump the asset, the patient algorithmic capital steps in, buys the absolute bottom of the panic, waits out the hysteria for a few days, and calmly collects the premium when sanity returns to the market.
That's the ideal scenario.
But, as the paper's author, Cyril Dejava, outlines in the conclusion, executing this in the wild is incredibly dangerous if you don't know what you're doing.
Oh, absolutely. Translating theoretical quantitative research into a live trading environment is notoriously difficult. The researchers provided several crucial survival tactics for anyone attempting to deploy this kind of statistical arbitrage.
Let's talk about those survival tactics. I think the first one is that execution venue and order type matter immensely. You cannot use aggressive market orders.
Right. If you use a market order, meaning you demand to buy or sell immediately at whatever the current best available price is, you are crossing the bid-ask spread and taking liquidity. You will likely eliminate your entire profit margin instantly.
It's just gone.
Yeah, you have to use passive limit orders. You set your price, you wait for the market to come to you, and you act as a liquidity provider.
Okay, the second major takeaway is about understanding your own pain tolerance. The researchers noted that even the best, most optimized mean reversion strategies saw maximum drawdowns of anywhere from 3% to 21%. If you over-leverage your account, a 21% drawdown will force a margin call and wipe you out before the pendulum can even swing back.
And this is where the Kalmar ratio becomes critical.
Right.
We discussed the Sharpe ratio earlier, which measures return against general volatility. The Kalmar ratio specifically measures your annualized return divided by your maximum drawdown.
Okay, so it's focused on the worst case.
Exactly. It is a direct metric of worst-case scenario pain tolerance. A high Kalmar ratio means the strategy recovers from its deepest losses quickly and efficiently. If a strategy has a 30% return but a 60% drawdown, the Kalmar ratio is terrible, and practically speaking, most human traders will abandon the strategy in terror before it ever recovers. Position sizing must be dictated by your maximum historical drawdown.
The third survival tactic actually blew my mind. You have to watch out for extreme liquidity gaps. While the safe Jesus contract had incredibly tight, reliable spreads, the speculative contracts exhibited terrifying tail risk. In the 99.9th percentile of observations, the bid-ask spread on the alien contract blew out to an astonishing 12.42%.
Yeah, a 12% spread is a total liquidity vacuum.
It's insane.
If your algorithm hits its 5-day holding limit and blindly attempts to exit the position during one of those vacuums, it is selling into an abyss.
Wow.
The market is temporarily broken. Practitioners must code safeguards into their systems to halt trading when spreads widen beyond acceptable parameters.
Makes total sense. And finally, you cannot put your entire portfolio into a single event. Decentralized binary contracts carry unique, non-zero probabilities of unexpected settlement disputes or, ambiguous real-world outcomes. You have to diversify. The researchers suggest spreading your capital across ideally 100 or more unrelated binary contracts to smooth out the isolated event risk.
Right, you are relying on the law of large numbers. If one contract resolved in a bizarre, unpredictable way due to a technicality, it should only represent 1% of your overall risk.
It's incredible how much structure is required just to safely exploit people freaking out on the internet.
It is, but there is one final dynamic to consider, which builds on a piece of literature cited early in the paper. The researchers referenced an independent analysis by McCullough that examined the predictive accuracy of Polymarket over time.
Okay.
That analysis found that the platform's overall accuracy improves dramatically in the final month before an event resolves. It hits approximately 90% accuracy a month out and rises to 94% accuracy in the immediate pre-settlement period.
Well, that makes intuitive sense. I mean, as the deadline approaches, the ambiguity fades. The crowd actually gets incredibly smart because the real-world evidence becomes undeniable.
This raises an important question, though. If mean reversion relies entirely on the pendulum swinging back from an emotional overreaction, what happens when that pendulum loses its momentum? What happens when the event date is actually arriving?
Oh, I see what you're saying. If there's only a week left before the end of the year, a sudden 20-day price drop isn't a temporary emotional panic for your algorithm to exploit.
Precisely. In the final stretch, that a massive price drop might be the hard, undeniable truth finally pricing itself in.
Wow.
The market isn't overreacting. It has simply realized that the event is definitively not going to occur. The mispricing isn't a rubber band waiting to snap back. It's a permanent repricing of reality.
That is a chilling thought for a quantitative trader. You watch the price tank, your algorithm steps in to buy the dip, expecting the pendulum to swing back, only to realize the pendulum is glued to the floor. It's a really powerful reminder that behind every data point, every 10-minute interval CSV file, and every $2.4 billion transaction cycle, there is the unpredictable reality of the world we actually live in. Most of the time, the crowd is just emotional and exploitable, but sometimes, actually dash that, sometimes the crowd is right.